We all know that real estate has created more millionaires than any other industry on the planet. We also know that it has created a lot of heartache due to mismanagement, overborrowing, and just simple life events that happen to all of us. Welcome to the CashFlowPro podcast. My name is Casey Brown, and I am your fearless leader. And although we might be bourbon sipping and at times foul-mouthed Southerners, we will always do our best to be honest, straightforward, and due diligent with all of the information we pass along to you. Welcome to the show. Hey there, and welcome to today's episode of CashFlowPro, your daily real estate investing podcast and YouTube channel. I'm here today with Jacob Vanderslice of VanWest Partners. And we were just comparing having an even number of kids versus having an odd number of kids. And I think we determined that, and we solved all the rest of the world's problems while we were doing that. So anyway, Jacob, how are you today, sir?
I'm doing great. And I think we determined that both even or odd is hard. It's hard either way.
Nothing easy about any of it, is it?
Nothing easy. Yeah.
That's right. That's right. He said he gets to run off and be with, you said, watch toddlers all weekend, right? Is that what you said?
Yeah, that's right. Yeah. My wife's been on the road this week, and she gets back real late tonight. And typical day for us is, work by day, come home, toddlers, evening, night, sometimes early in the morning, and rinse and repeat. Yeah. And parks and bikes and playgrounds on the weekend.
Yeah, man. But I've heard the old adage that you're going to miss it someday. I've heard that enough over the life of my children, and I'm just like, gosh, damn. But then I'd stop and be like, am I really going to miss just the complete aggravation of the 4-year-old having a meltdown because they're whatever, I'm like, no, I don't miss that. I'm not going to miss that. I guess maybe someday you will, but I don't know. So
the 3-year-old's almost out of diapers. So that's the next stage that I'm looking forward to. We're getting close.
And that's great when you hit that last diaper thing and you think you're going to get a raise, and then, raise monetarily because you don't have to buy diapers. And then they start growing so fast. All of the diaper money is then multiplied by some power of, and you're buying clothes every 2 weeks. So,
yeah, different stages.
Agreed. I guess economically, children are probably not the best, but they're a good investment. So
that's right.
Immediate economic return. So anyway, Jacob, tell us a little bit about you and VanWest Partners, how you got started, where you came from, and what your business looks like today.
Well, we're just a bunch of real estate hacks, and we've been real estate hacks for 15 years now. We started off in single family residential. We did a ton of fix and flips all over the country. We got into commercial real estate in 13 and 14 with some adaptive reuse retail projects here in Denver. We did some townhome development, some multifamily. We've kind of covered a lot of food groups, and we got in the storage business towards the end of 2015. And we looked at it for a while, and we liked the fact that it's historically downside protected. It's durable income streams. It's repeatable, scalable. So we raised some money, and we built a project here in Denver, and then we did some more. And then we moved into the Milwaukee market, and we didn't really intend to do this when we got in the business. But over time, we became primarily self-storage owners and operators, and that's become our primary line of business. We did our first storage fund in 2019. Everything leading up to then was single asset syndications. Did our second fund last year. We closed that up. We're on fund 3 right now. So we got about 35 facilities around the country. We're building a couple here in Denver. We've got a few deals we're buying in Oklahoma in October, Michigan. We've got some deals in North Carolina in the pipeline. It's been a good business for us, and it's working for right now. So we're gonna keep going.
Man, I'll tell you, the number one thing about the self-storage business that I've seen, and I'm personal friends with a lot of very big self-storage operators. And the one thing that I see being, because at some point, I have two things. Number one, it's like, how many more units does this country need? I mean, eventually you would think that it's gotta get saturated at some point, but it doesn't. It just keeps booming. And then I'm curious of the forecast, or what kind of forecasts you all have thought about or looked at, or just any type of potential underwriting hiccups that might happen from that perspective. And number two, the competition. The worst part about that business right now is the competition for new properties. And because like I said, between you and the 3 or 4 other, I'm talking sizable operators that I've had on this show, that I talk to regularly, that I know, it's like, and that's just a sprinkle of the even larger operators that are out there. And I'm just like, gosh, dang, it just keeps going.
Yeah, I always like talking about how things are going to go wrong versus how they might go right. That's more fun and I think productive. So
Well, it creates a dramatic effect, which is what.
yeah, we can touch on the risks in the asset classes as we view them. So the first risk, as you touched on, is the introduction of unforecasted new competition or supply. That's a big risk. The second risk is rents, right? And that's kind of a risk in any real estate asset class. And I think the third big risk is property taxes. Storage leases are full service leases, and it might sound like I'm going in the weeds with property taxes, but if you're not accruing the right number and being conservative, you're going to have a material negative impact on your deal if you're wrong. So on the competition side, we generally target markets where, we're doing development deals as well, and that's kind of a different strategy. But for the markets we're targeting for acquisitions, we're targeting markets with rents that don't support the cost basis of ground up development. So the risk is kind of mitigated to a degree of somebody building a facility nearby you, because it just won't pencil. The rents are not high enough. Cost to build are, as you can imagine, just like everything, they're through the roof. They're higher than they've ever been. But new competition that you're not quantifying can really beat up your deal. We did some development deals here in Denver that delivered in 2017, and a bunch of other guys at the same time had the same idea. And we all came to market within a couple quarters of each other, and our leasing and our rents really suffered. Now, eventually they recovered and we traded out of those deals and made money.
Yeah.
But lots of competition and saturation is really a material has really a material effect on rents and occupancy. So that's definitely a risk profile. And then on the rent side, whether it's self-storage or multifamily or retail, so much of your value creation is on the revenue side. Yeah. And if you're a little bit wrong in your forecasted revenue stream, that's an exponential impact on the total value of your deal. So that's why we kind of call rents out as one of our 3 risks. We think rents are, in-place rents are 80 cents a foot per month. Market rents are $1. We're going to get them up to 95 cents. In our model, let's say we only get them to 85, right? That's a big material change.
Yeah, it's 10%.
So
or more than 10%.
Yeah, those are some of the risk factors, but you can talk about why we like it for a moment.
Let's talk. I want to hear property taxes.
Property taxes. All right. So
obviously they're going to go up. I see inflation, everything else going up, so they're going to go up too. But what is the?
It's market by market. So we have some deals in the Midwest, like in Ohio and Illinois, and you just get murdered by property taxes up there. They're so egregiously high. And if you're not, let's say you buy a deal and you accrue for 150 grand on a go forward basis in property taxes, and in 18 months you get reassessed at 225.
Yep.
So that delta in your net operating income is 75 grand, and you put a 5 cap on that. That's a lot of value that just evaporated. So we try to be excessively conservative on our tax accruals, because we know that, the deal could be going really well. You could be growing NOI, occupancy, everything's good, and you miss that assessment number, and you just go way backwards in time in the wrong way. So that's something we try to mitigate too. On development deals, taxes are much more difficult to forecast, right? Because it's just been raw land. There's never been a storage facility there. So we'll bring in tax consultants and kind of have them give us a base case, best case, worst case scenario on what to accrue for. But even sometimes those guys are wrong. So you really got to be conservative on the property tax side, especially in the Midwest. Not to knock the Midwest. We own there. We operate it. We operate there. We like that market or those markets, but they've got pretty high taxes.
Yeah. and we haven't discussed this, but I'm actually, I was born here in Kentucky and was raised in Colorado Springs. So we make several family ventures back that way because I still have quite a bit of family that lives there. And the thing is that Denver in and of itself has just exploded in growth. And some of these people like I don't know what it is, but Americans. So when you start talking about why you like it, one of the hedges I always felt like was as long as stuff is being, it's like stuff, as long as stuff is being shipped over here from say China, or stuff is being shipped over here in the form of clothing from Pakistan or India or wherever, Americans for some ungodly reason cannot get rid of this stuff. They can't do it. It's mentally, there's something there. So it becomes, I look at, and I'm going to tell you the truth. I've said it on this show before and I'll say it again. My wife has a storage unit, right? $75 a month. And the thing is it's probably got $500 worth of stuff in it. Okay. Take a guess on how long and I'm telling this story on my podcast that's called CashFlowPro, like make wise investments, make money, do this that makes money. And I'm sitting here that's why I say it's my wife's damn storage unit and not mine.
There you go.
Probably got $500 worth of stuff in it. And she pays $75 a month, and take a guess on how long we've had
it. It's going to be a long time. I'm going to under deliver here. 2 years.
We've had it like 3.5 ish.
3.5. Well,
so we have now paid $650 or no, $750, $900 a year for 3.5 years to store $500 worth of shit. And I'm just like,
God bless your wife. She sounds like our typical customer. So our typical customer has got two things. One is they think they're going to store for 3 to 6 months, and they stay for 18 months plus.
Yeah.
Secondly, they'll spend $1,000 a year to store $500 worth of stuff.
It's just, it's so insane to me. This, I just, so for one, I look at it, this is the way I based it. And this is what I told her. I said, that's a tax. It's a tax. That's just basically the way it is. Because Americans can't get rid of their stuff. So now we pay to store said stuff for long periods of time. And it created a business model that has very, very, very little downside potential.
It's out of sight, out of mind. It auto drafts or automatically hits your credit card every month. If you see a rate increase of $5 or $10, you're not going to go move it out to save that money. I have a storage unit in one of our buildings, and the stuff I keep in there is my seasonal gear. And I've got family heirloom furniture too that is sentimental to me and probably worthless. I don't want to get rid of it, but I don't want it in my house either. So there it sits in the storage unit, and there it will be in perpetuity.
It's the American way.
That's right.
I'm glad to hear that somebody else is doing that. They're like, damn, I don't want that thing in my house, but it was grandma's, and I'm not getting rid of it.
She is not the only guilty one here.
All right. Well, you know, and all of these things that you and I are professing here are by the way, investors, invest with us, please, because we're really good with money.
That's right. As we spend $75 a month on storing useless stuff.
We want the family heirloom. So anyway, no, man, I just, when you start talking, like the upside part of this conversation, and that's part of the way I always judge an asset class or a new asset class, is how long the conversation would take for the downsides and how long the conversation is going to take for the upside. And this conversation beginning now, talking upside of self-storage, could literally go on between you and I from now till this time tomorrow, or maybe even longer, because of we're growing. It's like agricultural ground, right? We're a growing population. Not only are we a growing population, but we're also a growing population of hoarders, basically, where again, one hoarder, I guess if you will, has 3 kids. now you basically are just, we're growing, and we're growing in stuff, and we're growing everything else. And so, but what I'd like to hear a little more about is some of maybe like your top three upsides of what you see, because the the competition in the market, and the the other thing that I see as being a challenge for new development is the locations. It seems to me like the locations are going to get more and more like costlier, I guess, if you will, because
Yep.
I think there's gonna start to be some really serious zoning changes when it comes to these things. And I think there's gonna start to be, because I think obviously the cities are seeing what kind of income is being generated, and so they're going to
Yep.
start making zoning changes that are, like you said, could potentially affect property taxes and everything else. So what are some of, like, maybe say your top two or three upsides that you see as benefits?
Well, Casey, you teed up one of those points in the fairway for me. So that reason is exactly why we're developing right now, and developing pretty aggressively. We have never seen the barriers to entry for competition be higher than they are now.
Yeah.
And that's really, I think, for two reasons. One reason is it's more difficult than it's ever been to get projects entitled. Cities are pulling back on zoning codes. They're making self-storage a conditional use versus an allowed use, which means you have to get approval. They push back on your design, on your setbacks. It's really a knife fight in many locations to get a new development approved, and which means it's harder for somebody else to get it approved as well. And the second big barrier right now are the cost to build. They've never been higher, obviously. They're a lot higher than they were a couple of years ago, but rents have gone up incrementally faster than hard costs have. So it still makes sense to take on a higher cost basis, given the yield on cost you'll build to. So our thesis generally in developing is we create a Class A product. It's brand new. We build it in a location that is very difficult, if not impossible, to replicate. And in theory, we and our investors are rewarded with a premium strike price when it comes time to monetize, because a buyer knows that it's really tough to replicate this. So that's one of the upsides on the development side. But generally in the industry, one of the many reasons we like the asset class is the granularity of the revenue streams. We're relying on thousands of customers on month-to-month leases to pay us $30 to $300 a month, whatever the case might be.
Yep.
And the chances that a bunch of them are going to roll over at the same time are very low. So we have some retail projects here in Denver. For example, we have a brewery that's paying us about 30 grand a month in base rent and CAM. That's a lot of money. If they stop paying, yeah, it's a lot of money. I mean, it's a triple net lease. They have high property taxes,
Wow.
but either way, it's a big monthly nut. So if they don't pay, it's going to take us a long time to get them out. It's going to cost us a lot of money to find a new tenant and a lot of time. And that revenue stream is not easily replaced right away. Well, if we have a storage customer roll over on us who's paying us $50 a month, we overlock their unit, we put somebody in there that's going to pay. And the fact that leases are month to month is attractive to our customers because they're not committed to a long-term lease, even though some of us stay in there for 3 years, right? No big deal.
Sure. Yeah.
But we're not committed to it.
Yeah. Some no-name people stay in there for 3 years.
That's right. But they get the flexibility to kind of come and go as they please. And the month-to-month lease works well on the ownership side, because when we start to fill up units, over time we can increase rates and probably not get many move-outs. If a guy is paying, again, $75 a month and you increase the rate to 82, you put some new gates in and security cameras, you show you're creating some value. They might not be happy about the $7 increase, but they're not going to move because they're going to have to go somewhere else and probably pay the same price or more. And they're also going to have to get their truck and their buddy on the weekend and spend a bunch of time loading and unloading their stuff. They're just going to digest the rate.
People think in the now, they don't think that $7-10 a month is going to actually be $120 over the next 12 months. They think, $10 a month, whatever.
Yep. And it just auto drafts, out of sight, out of mind. So we like the granularity of the revenue streams, and we like the ability to really dynamically manage the revenue. And it goes in both directions too. If you have a deal that's not going well, let's say you have, a bunch of 5x5 unit types that have low occupancy, you can drop your rates really aggressively below market and start to fill those up with customers. And as you stabilize, you can push those rates up over time. So you can kind of respond real time to supply and demand changes based on how a deal is performing. So we like how all these tiny kind of not very meaningful revenue streams add up to be very meaningful in aggregate.
And I'll tell you, I had a guy, one of the operators was telling me, or we were talking a little bit about some of the ways that these things are being automated, where people like basically walk up, slide a credit card. Now the credit card's stored on file, and they can move in like with, and you don't even have, they can do this at midnight if they want. I assume, I guess, I don't know that midnight was really of the discussion, but I mean, they can do it basically at their own leisure. And he said that kind of cut their workforce needs in, like, they still needed somebody to man whatever it was, whatever additional stuff there is. But is that something that you see? I just, for me, I just don't see that being a forever kind of thing. I think, I mean, or do you see the automation of that being something that's permanent, that's here, that's going to continue to evolve and become the way it goes?
Well, early on, we experimented with completely remote managed facilities. And I don't know if it's because we didn't do it right, but it didn't go very well. Bad things tend to happen when there's not an on-site personnel member there.
Yeah.
We do have a number of facilities that are a little bit smaller that we kind of call satellite locations. And there's an on-site member of our staff within a mile away if there's an issue or a customer problem, but they're not staffed full-time. If you're looking at buildings that are, very large, multi-story, climate controlled, bad things can happen in those corridors when people are not policed. So we staff those full time. On the automation side, customers can still lease a unit, move in, get their gate code, do everything without ever talking to a human if they choose to, either on the phone or in person. They can do it all online. Some people just still like to walk into the leasing office and talk to the person and have a face-to-face interaction.
Yeah,
Some
and
people
let's be honest,
to,
it doesn't take a MBA to run one of these things. I mean, it could be somebody that's $12, $14, $15 an hour, right? I mean, it doesn't take
that's about right. I mean, it's not overly complicated to be a property manager. I mean, you deal with some software and you deal with the occasional customer service issues, but yeah, you're just leasing storage units and making sure people are happy. So it's fairly simple. But we leverage as much automation as we can. On our new development projects, we're looking at a system that's Wi-Fi based that'll allow you to unlock your door with using your app on your smartphone. It's got an RF chip in it. You just kind of put it next to your door. It unlocks. You come and go using your phone. We generally don't do that on our acquisitions, kind of our older facilities that we'll buy. But there's a lot of technology in the space right now that wasn't there before that really makes the leasing experience a lot more seamless. It's like a mobile order at Starbucks, right? I don't want to talk to a barista. I want to just order it 5 minutes out, park in front of the building, walk in, it's on the counter, walk out. But some people want to go talk to the barista and wait in line and go through the
have
whole
the experience or whatever.
Yeah.
That's what they always said. Howard Schultz said he wasn't actually selling coffee; he was selling an experience.
Yeah, I believe that. I believe that,
and that's the truth. When people feel like you can give them their money's worth in experience, then they don't mind paying. So,
yeah, in the storage business, I mean, when you go to Starbucks, you're probably excited about it, right? You're ready to get your coffee. You're excited about it. It's going to give you a little lift. It's a nice place to go into. You're going to drink it on your way to work. If you're storing, you normally don't want to be there. You're normally going to that storage unit because you've got something going on. Yep. You're moving. You just came to town. Moving is not fun. Nobody likes moving, and so typically you're not overly excited to be there in many cases, and we certainly try to remember that when we interact with our customers. A lot of them have stuff going on, and sometimes you kind of end up being a counselor to a degree, whether you like it or you don't.
Yeah. I always get my head shakes out real good whenever I get there. I just like all right. So the next thing that always kind of creeps up in the discussion of self-storage is, and I learned this not long ago, was that when you have a multi-level unit rents go down the higher up you go. And of course, they look really good from the interstate. And of course, they look really like they're eye candy from wherever you go, because it gives this Barbie doll in a package feel to the storage business. But I'm just, do you all have any multi-level facilities? And if you do or don't, I guess, do you? First question.
We
Okay.
do. We
So
do.
do
Yep.
they, and I'm sure you have some single level facilities as well, right?
Certainly.
And how
Yep.
do they compare when it comes to, like, what numbers would you use to compare the two? And is there one contrast, or I mean, was one better than the other necessarily, or?
Well, all right. So you're a storage customer. You what do you want to do? Do you want to show up, put your stuff on a cart, push it into a building, wait for an elevator, ride it to the third story, push it 100 feet down a hallway, rinse and repeat? Or do you want to show up to a garage door in your truck, park 5 feet away, open the garage door, load and unload, and leave? Obviously, answer two, right? That's the most convenient. So, generally speaking, the multi-story climate control facilities that we've seen perform well and that we've done over the years are in very core, dense infill environments where there aren't really other options out there for a traditional drive-up unit. Um, the deals that we've seen not perform very well are in more suburban locations without a lot of density. And if someone has the option to not ride the elevator up, they're going to take that option. So what you end up seeing is a big discount on elevator access floors versus the main floor, because you got to wait for the elevator and you got to ride up and ride down. So when we're building a new facility that's multiple stories, we discount elevator access floors pretty heavily in our underwriting. Eventually, once you fill up, you can start to push those rates up. But the algorithm that we use, it's not really even an algorithm. There's a lot of human touch to it. But if you're riding an elevator, it doesn't really make much of a difference whether you're going to the second or the fifth floor or the fourth floor, right? You're still riding the elevator. The time to ride it up is not that different, other than having to maybe stop here and there coming down if somebody else is loading and unloading, which is unusual because there's not usually a lot of people in a storage facility. But our favorite deals have been the single story drive up deals that have a combination of climate controlled and non climate controlled units. The real high demand unit types are drive up climate controlled, where it's not too hot inside, it's not too cold inside, and you can drive up to the garage door and load and unload, and you're not worrying about the temperature swings, in the winter and the summertime. Those have definitely commanded the highest rent per foot out of all the deals that we've done.
Sure.
So we do both, but you really gotta. I mean, every storage unit is in our portfolio. Every individual unit is kind of its own product type. And let's say you have 10 by 10s that are elevator accessed. Well, a 10 by 10 that's right next to the elevator is going to command a higher price than a 10 by 10 that's a 100-foot walk down the hallway and a right turn, right?
Mm-hmm.
So they're all their own kind of product types. And when you're thinking about either building or making an acquisition, you have to understand the different revenue that those different product types are going to command over time.
Hi, this is Casey Brown, host of the CashFlowPro podcast and YouTube channel. Have you been thinking about investing in real estate but just don't know where to begin? I'd like to help by inviting you to check out our website at www.3000capital.com. There you will find an array of material that will help you learn all about real estate syndication. And while you're there, be sure to check out our free video series download titled 5 Must-Know Keys to Success in Passive Real Estate Investing. I'd also like to personally thank you for making CashFlowPro part of your day. Now, back to the show. I like the model. There's a place here in town where I live where it's got both types of units. The interior units, you walk down a hall and they're all climate controlled, right? And then on the back side, there's outdoor units, I guess, and they insulate between the walls or something. I don't really. So it's a little bit of both, I guess, and it's kind of, I guess, from a maybe a building perspective, you don't need an extra wall or something. I don't really know what the overall savings is, but anyway, needless to say, it's one of those businesses that's going to keep evolving. I just, when you think about, like, I don't even know what year the first self-storage stuff really started taking off, but I can almost assure you that my grandmother and grandfather never had a self-storage building or self-storage unit. For one, they just never bought that much stuff. Number two, my grandfather sure wasn't going to drive somewhere to get to his stuff. But the thing is that as it's came and evolved, the base product hasn't changed a lot, but some of the, I guess maybe the benefits have or whatever. And as it continues to consolidate, it's just a very interesting business to me because it's so simple, so easy. It's almost like it's almost like billboard income, really. When you look at it from the management, you got a little bit of just a little bit of management and a lot of income. So anyway,
Yeah.
All right, Jacob, listen, we ask a couple of questions every guest that comes on the show. The first of those questions is, what is the best book that you've recently read or are currently reading?
Well, I mostly stick to historic nonfiction. I've done all the standard real estate books, but that's normally what I read. And right now I'm about halfway through a book called Spearhead by Adam Makos. It's a great book about a World War II tank crew. And it talks about kind of the German perspective and the American perspective equally. It's great so far. Apparently the ending is unexpected, which I'm looking forward to. One of our investors gave it to me. But I generally like books, like historic nonfiction books that about leadership and conflict.
Sure,
I get a lot of value out of this.
Yeah, I'll tell you, one of my favorite historical nonfiction books series that I've ever read is, and I don't do a ton of that, but I like the Killing series
I've gotten through most of those. I haven't gotten them all, but those are good, easy, entertaining reads. I like those.
Yeah, the entertainment level is pretty high, and the way it is. He's got a co-author there that really just brings things to life and makes.
Yeah, Bill keeps churning those things out. I think once a year, like clockwork.
Yeah, and the last one was Killing the Killers, and it was fabulous book about killing the terrorists and so on. So anyway, next question. What is a dream vacation that you have taken or hope to take?
Gosh, I've had my eye on the Maldives for a long time. I'm a scuba diver.
Haven't we all, though?
Yeah. Everybody wants to go there. I'm not sure when I'll get down there, but I hear the diving's great. It's a trip to get there. Do a fair amount of mountain stuff too. I've spent a little bit of time in the Alps. I'd love to get back and do the Eiger though, or climb Mont Blanc. So someday when the boys are older.
I know. And that's what is so entertaining to me about this business is this is the way you can buy that time back and keep churning it forward, or hope to.
That's the idea. The ROI on time is very valuable.
Yep. All right. Well, listen, we have a good bit of investors that listen to this show. We have a good bit of entrepreneurs in general that listen to this show. If anybody that listens to this show wants to reach out and get in touch with you, what's the best way for them to do that?
Well, I always love to connect to talk shop about real estate. They can email me, Jacob at VanWestPartners.com. Go to our website, VanWestPartners.com, or hit me on LinkedIn, Jacob Vanderslice.
All right, man. That's awesome. And thank you. I know you're a busy man, as much self-storage as you all got going, and you need to go clean out a unit as right now, right? Didn't you say, you're not going to give up your unit? I'm giving up my unit. That's what I got to go do.
That's right.
No, my wife is giving up her unit, and I got to go help her. So
we'll both commit to giving up our units, and we'll follow up with each other in the month and see if we
maybe that's going to, hey, what if that becomes the next viral New Year's resolution?
There you go. Well,
I'll do my storage unit for this year. Anyway, awesome, man. Listen, thank you so much for cutting out the time out of your day to be with us. And listeners, thank you for taking the time to be with us today. And as always, please head down and smash that subscribe button, and also leave us a review so that others may know what you enjoyed about listening to the CashFlowPro podcast. And again, thank you, Jacob. Thank you for your time. I hope everybody has a wonderful rest of the day.
CashFlowPro is hosted by Casey Brown, founder and CEO of 3000 Capital, a commercial real estate investment firm committed to providing its investors with ongoing cash flow and helping them build long-term wealth. If you enjoyed today's podcast, make sure to hit that subscribe button so you'll be notified about all our future episodes. You can find more information about us and our investment philosophy by clicking the link in the show notes below. Thanks for listening.